In this video, we're going to be having a look at the capital and financial account, which is essentially the financial account is used to fund the current account. So any deficit in the current account will be funded through transactions in the financial account. So when a country runs a current account deficit, that means that in that given year, households, businesses and the government, so we're talking about private and government entities here, are not saving enough for their investment, and essentially the total level of spending in the economy is exceeding the total level of income. So current account deficits do so, countries that run current account deficits do so because they spend more than they earn. And essentially the financial account is essentially saying, how are we funding this money from the lack of, how are we funding this savings and investment in balance, or this difference between expenditure and income that occurs within the current account. So the sections of the financial account, it's broken down into two, the capital and financial account, You have the financial account, which is important, we're talking about a lot in this video, and the capital account, which is relatively insignificant. The financial account is important and more important than the capital account because that's how we fund the current account. So in terms of Australia's current financial account, if we experience a current account deficit of $46.8 billion for the year, that essentially meant we spent $46.8 billion more than we earned as a nation. So our G&E, or our national expenditure, has exceeded our national income, and that's because we've spent more on imports and servicing our foreign debt, so through interest and profits flowing overseas and things like that, than it's received from our lending and from the earnings on our foreign assets. This $46.8 billion shortfall, we finance that in the form of loans or selling assets to other countries. So the credits in the financial account are essentially the call on us to borrow money from overseas. Financial account will have a surplus when we're borrowing and selling off more of our assets than we are lending and buying assets overseas. So a financial account effectively shows how we record our excessive spending in the current account deficit. How do we fund that? And it's mostly funded by the loans, by going into debt, or by the sale of assets, which is equity transactions. Both of these will lead to an increase in our net foreign liabilities, which we'll talk about more later this week. So, in terms of the financial account, there is two main concepts you need to be aware of: the idea of capital inflow and capital outflow. So, capital inflow will always be recorded as a credit, and essentially it's a transaction. So, capital inflow is a transaction when Australia is receiving money, and it's only receiving money from transactions that belong in the financial account. So the two types of capital inflow we'll talk about mainly is either borrowing money from overseas, so when we issue debt, or when Australian companies sell off part of their company overseas. So essentially that's equity financing. So it refers to overseas parties being attracted by high interest rates, and essentially either we borrow money from other countries or we sell them their assets. Capital outflow is when funds leave the country, and that can be in the form of either lending to other countries or in the form of Australians buying foreign assets. In terms of cash flows in the financial account, we have official cash flows, which is the money related to the government, and non-official cash flows, which relate to businesses and private individuals. There's two types of borrowing, which we'll talk about, and then two types of equity financing, both direct and portfolio investments, both relate to rather than borrowing money, we sell off assets. So official capital inflow is a credit, and that's when the Australian government borrows money from overseas. They generally do this by selling bonds to overseas entities, and in effect the overseas residents are lending the Australian government money. The opposite to capital inflow is capital outflow, which would be the Australian government buys a bond and lends money to countries overseas. Non-official borrowing is exactly the same, but just borrowing and lending between Australians and overseas residents. So when Australian residents borrow from overseas, Australia borrows from overseas residents, it's a credit, and when private entities lend to overseas, it would be recorded as a debit. So we generally run a surplus because we've got a lot of credits from private borrowing. Most of our borrowing is private. Net direct investment, foreigners purchasing Australian companies. So a credit would be that, for example, if I purchased more than 10% of the shares in Vegemite, or any time a foreign entity sets up business in Australia, they have to pay for the land to establish that business. That would be an example of a credit as well. A debit is any similar investments by Australian residents overseas. So if an Australian company sets up operations overseas, if Australians are investing in shares and buy over the 10% of the shares in any company. Portfolio investment is less than 10%, so that would involve capital inflow in the form of selling people overseas buying shares in Qantas, less than 10%, and a debit would be Australian residents investing abroad. So for example, if I purchase shares in Apple as part of my super, that would be recorded as a debit because the money flows overseas. So that's how you break it down. You've got your net official capital flows and non-official capital flows. Again, official capital inflows, borrowing by the government, and outflows would be lending by the government. We've got borrowing and lending from private entities, and then these ones here are your equity transactions, which relate to buying and selling of assets. Capital inflow has nothing to do with the current account. So when you're talking about capital inflow, don't talk about exports and imports. It's all about transactions in the financial account. The higher the current account deficit, the higher amount of capital inflow we receive, because the money flows back into Australia in the form of us borrowing or us selling off assets. So capital inflow will increase when we run a CAD because the money will flow into Australia in the financial account through borrowing or selling off assets. So if you look at this table, for example, or graph, you can see here that net capital inflow is inflow minus outflow. So you can see here, because they're in positive figures, so the pink or the purple are all positive, that means that in that given year we are borrowing more than we are lending. Capital inflow from borrowing exceeds capital outflow from lending, and even though it's only been a slight difference in recent years, net foreign debt's still increasing. In these years here, net foreign debt was increasing substantially, and then it started to slow down after the GFC as we invested less. Net equity, capital inflows from equity, these blue lines being above zero means that we're selling off more of our assets than we are buying or purchasing of foreign assets. If we're below the line like we are here, in these years it means that Australians purchased more foreign assets than foreign entities purchased in Australia. Because we always run a current account deficit, we always have capital inflow above zero, and that's why these figures are always on net above zero. Even though equity is below zero here, the total amount is still a positive figure. We have more credits than debits in our financial account because we run a current account deficit. The main reasons for capital inflow is that, one, Australia has low savings rates. So we borrow a lot of money from overseas because our banks don't have enough money from our private savings. So when you borrow from like the Commonwealth Bank then goes and borrows from other entities overseas, and that leads to capital inflow. There's also capital inflow to fund from the government to fund their budget deficits, because they're spending more than they're earning, so they borrow in the form of bonds or official borrowing, and because we have high current account deficits, we have to fund that through the financial account, so capital inflow comes in there as well. Why would credits in the financial account today lead to more debits in the future in the current account? That's because any time that we have credits when we borrow or sell off assets, we have to either pay interest on our borrowings, profits if we sell off our companies, rent if we let foreigners buy Australian property, and dividends if they're buying shares in Australian companies. The capital account is not important. Okay, it only includes one-way transactions involving migrants and certain copyright patents and things like that, but you don't need to know what's in the capital account. Okay, thank you.